Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're talking about second homes and how that could be impacting the market. But first, we're going to be hosting a second in our monthly webinar series on artificial intelligence, specifically on the use of AI in real estate and a real estate investing business. I'll be giving live use cases on the webinar. This is not a theoretical talk. This is active use cases from a practitioner who's doing this on a daily basis. To register for the webinar, click on the link in the show notes and we'll talk to you June the 4th, 8 p.m. Eastern Time. And if you can't attend, register anyway. We'll send you a recording of the webinar. On today's show, we're asking a question that I think deserves a lot more attention than it's getting. There are 6.2 million second homes in the United States. Let that number sink in for a moment. According to the National Association of Home Builders, second homes now account for 4.3% of the nation's entire housing stock. That is not a rounding error. By the way, this is a very similar number in Canada. That's a meaningful slice of the market, and it's a slice that sits on a very different set of financial foundations than a primary residence. So today I want to explore a scenario that has not really been talked about. What happens if even a fraction of those 6.2 million properties hit the market at the same time? We could see a replay in slow motion of the inventory surge that helped collapse prices in 2008. So let me walk you through the mechanics. Let's look at how we got here. During the pandemic, second home mortgage originations hit a peak of 5% of all mortgages in 2020. That's a historic high. Low interest rates, remote work, these converged, and affluent Americans decamped to vacation destinations in huge numbers. It was like a gold rush. And like most gold rushes, the buyers weren't thinking carefully about what happens when conditions change. Between 2020 and 2021, purchases of second homes with high flood risk rose 45% from the prior 2-year period. There was also a significant increase in purchases of second homes with high storm risk, up 40%, and high heat risk, up 39%. Overall, second home purchases were 37% higher in 2020 and 2021 compared with 2018 and 2019. In other words, millions of buyers rushed into vacation properties in climate-exposed locations at low rates, with the assumption that the good times would roll indefinitely. Well, that assumption is now being tested. Here's where the pressure is building. Owning a second home has become materially more expensive, not just in terms of the purchase price, but the ongoing cost of ownership. In Florida alone, average annual insurance premiums are projected to reach $15,460 in 2025. Rising HOA assessments, property taxes, insurance premiums have combined to make owning a second home, especially in Florida and other high-risk markets, more expensive and unpredictable than ever. I mean, think about that. You bought a vacation property in 2021 at a 3% mortgage rate, planning a modest carrying cost. Now you're holding a 3% mortgage against an insurance bill that looks more like a second mortgage payment. And that's before property taxes, HOA fees, maintenance, and opportunity costs of capital sitting idle in a depreciating asset. The median value of second homes nationally is $495,000, significantly higher than the median price for a primary home. So these are not cheap properties to carry, and crucially, they're the first thing people shed when financial stress arrives. You don't abandon the primary residence, you sell the vacation home. So this is where the parallel exists with 2008. Is this the same? Not exactly, but structural similarities are worth examining. In 2008, the crisis was driven by leveraged buyers who couldn't afford their primary homes. The defaults were forced. This time, the pressure is a bit more subtle. It's financial fatigue on discretionary assets held by people who can technically afford to keep them, but who are running a quiet cost-benefit analysis every single month. Go back to the period of the wake of 2008, some of the counties in the nation that led the steepest declines were those that had a high proportion of second homes. These were locations in Florida, Miami-Dade County, Broward County, in Las Vegas, in Arizona. Distressed sales are still only 2% of the total market today, down from about 18% during the Great Recession. So we're not in a major crisis mode yet, but we don't need a crisis to create a supply problem in specific markets. We need just a few percent of those 6.2 million homes to appear on the market, and the math no longer works. Second homes are heavily concentrated geographically. Florida alone holds about 944,000 of those units, 15% of the national total. Half of all the second homes sit in just 8 states: Florida, California, New York, Texas, Michigan, North Carolina, Arizona, and Pennsylvania. So if selling pressure materializes, it won't spread evenly across the country. It's going to hammer specific vacation markets like coastal Florida, like the Carolinas, some of the mountain towns, with a concentrated wave of supply hitting a relatively thin pool of buyers. So you want to monitor the availability of insurance, not just the cost. When carriers exit a market entirely, like we've seen in parts of Florida and California, that doesn't just raise the costs, it makes properties functionally unmortgageable for future buyers. That collapses demand at a moment when supply is rising. Then you want to look at second home mortgage originations. In 2024, they were at the lowest on record at just 86,604, down 5% year over year. And Americans are now purchasing roughly a third as many vacation homes as they were during the pandemic boom. Demand is already pulling back, and the question is whether supply is going to follow. So the 2008 crash taught us that real estate markets don't need universal distress to break down. They need concentrated supply, thin demand, and a loss of confidence. In certain vacation markets, all three of these conditions are already coming together. So as you think about that, pay very close attention. Have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.